Okay. So let me introduce myself while this is going. I'm Vanessa Sheppard. I'm a realtor with Home Smart Realty Group. I've been in the business since, I guess you could say, I'm a COVID realtor. When COVID first hits, I say I'm going to do what I said I was going to do. I'm going to accomplish those goals. So I end up taking the class to be a realtor, passed it, and there you go. I'm in the business now. And with that said, I've worked with investors, sellers, and buyers equally. So I'm a well-rounded agent. And with me, if there's anything that you have questions on that I don't personally have the answer to, I know how to get you those answers. I do work with a particular team of people and network a lot so we can get you the things that you need to move forward. And with that being said, I work in Chicago, Southwest suburbs, Northwest suburbs, anywhere my car can particularly take me, I'll be there to assist you when it comes to real estate. And with that being said, I'll just pass the throne on to Tony.
All right. So I am Tony Marino. I'm branch manager of the Marino team in Naperville with First Centennial Mortgage. I'm licensed in Illinois, Colorado, and Florida. Specialize in getting people into home ownership using down payment assistance, and use education to help people understand how they can become homeowners and part of the American dream. So the American dream, homeownership is still the American dream, and buying a home can be an exciting and intimidating process. So this webinar will provide you with the information that will help you begin to dream of home ownership. So why seek the American dream? There's a need and want to become a homeowner. However, there is too much misinformation. Do I really need 20% down? Many think they are years away from owning a home. 50% renters think they cannot afford the down payment. However, they have the financial means to maintain monthly mortgage payments. That is about what they pay in monthly rent, which we will go over later on. It enhances the quality of life and helps individuals with wealth building and equity appreciation. So here's some of the myths. 45% think you need a very good credit score to get a mortgage loan today. They think you need a good credit score at 780. 35% think you need 20% down payment. 31% don't think they can qualify for a mortgage loan. So what are the advantages of home ownership? A place of your own versus renting, stable housing costs versus rising rental costs, build equity, which builds wealth, get tax deductions on interest and real estate taxes you pay, borrow against the equity you build in your home or convert it to cash later when you retire. And then homeowners have 45 times greater net worth than renters. So now let's get into the home buying process. We'll go through that, and then we'll go through some programs and how you qualify. So the very first step that you do is you get pre-approved for a home loan for free. That's when we will pull credit. We'll see where your credit score is, and then I will see how much you can afford in purchase price, which we'll go over how we do that. Once you are pre-approved, then Vanessa will take you out shopping. We'll know the price. You'll discuss the size of the home you want, neighborhood, lifestyle. Once you find the place that you want, you make an offer, select an attorney. You will do a home inspection, radon inspection, roof inspection. Then you will send me the executed contract and loan docs. Loan goes through. So once we do the application, you sign it, and I ask for the additional documentation. We will then send your file to processing. Processing is just making sure that the documents that you sent match up to the application, make any corrections needed, and then we will send it to underwriting. So underwriting will, once it's out of underwriting, we will get a conditional approval. And the conditional approval is just anything that the underwriter needs to give the clear to close. So it could be we need an extra pay stub. We may need a letter of explanation for a large deposit, things like that. So once we get all that information, we will then resubmit it back into underwriting to get the clear to close. Once we have the clear to close, closing will be held at a title company or attorney's office. You sign the documents, seller receives check, buyer receives the keys and the deed, and you can move in the same day. And then this is just a little roadmap to what we just discussed. You got the pre-approval, home search, make offer. We do the application, submit supporting documents, home inspection, the processing. We order the appraisal, send it to underwriting conditional approval. We gather the conditions and then resubmit for the clear to close, and you go to closing. And typically, from when you go to contract, typically it's like 30 days to get you to closing. So these are the loan programs. We have VA loan, USDA loan. The two that we're mainly going to talk about is conventional loan and an FHA loan, and the IDA down payment assistance programs at the bottom. We attach the IDA program to a conventional or an FHA loan. So with the conventional that says 97%, that's the loan to value. That's how much you are borrowing. So 97%, you would be putting 3% down for a first-time home buyer. FHA, 96.5, so you would have to put 3.5% down. So the difference between conventional and FHA, the biggest difference between the two is when you don't put 20% or more down, you are required to have mortgage insurance. So that would be included in your monthly mortgage payment. With conventional, the mortgage insurance is dependent on your credit score. So the higher the credit score, the lower the mortgage insurance. FHA, doesn't matter where your credit score is, everyone gets the same rate for the mortgage insurance. And the biggest difference is FHA's mortgage insurance is for the life of the loan. And then conventional, once you have 20% equity, then the mortgage insurance will go away. So if you do go FHA, eventually down the line, once you have 20% equity, you would be refinancing into a conventional loan. So that's the main difference between the two. And so for our down payment assistance programs, which we will get more into later also, and there actually is a brand new one that started today. So we have the $6,000 forgivable grant. So this is after 10 years, it's forgivable after 10 years of living in the property. So it does get prorated each month. So $50 gets forgiven every single month. The trigger points are for if you have to pay it back is if you decide to refinance before the 10 years or if you sell the property before the 10 years. So if you decided to sell the property in 5 years, there'd be $3,000 left. So then you would have to, the $3,000 would just come out of the net proceeds of the sale of the home. And then if you sold it 11 years out, you would owe nothing. They have $7,500. This is deferred, so it just sits there. There's no interest that builds up. And the same thing, trigger points, you will eventually have to pay the $7,500 back when you refinance, sell, or the 30 years are up on the mortgage. The other one that's not on here that just started today, it's identical to the $7,500, but instead of $7,500, it is $10,000. Same thing, no interest builds up, but eventually you will have to pay that back. And then the last one that they do have is a $10,000. This is a repayable one. So it's $83.33 a month, interest free for a 10-year term. We'll get more into the IDA program in a little bit. So next, let's go into what we look at for qualifying, how you qualify for a mortgage. So there's 3 C's of lending. The first is credit. Second is cash flow, which cash flow is going to determine how much you qualify for. And then collateral, how much you're bringing to closing. So the first C, credit. So when we pull the credit report, we are pulling a tri-merged credit report, which the 3 bureaus is Equifax, Experian, and TransUnion. And as you can see, the credit score breakdown, the most important thing is your payment history. The second is amounts owed. This is amounts owed is talking about credit utilization. So if you have a credit card limit that is 1,000 and you are maxing it out at 1,000 every month, your credit score is going to go down. Ideally, they want to see that your balance to credit limit is 30%. So if you have $1,000 credit limit, you do not want to exceed $300 every time the billing cycle ends, because whatever shows up as the balance on your bill, that's what they're sending to the credit bureaus, and that's what's reporting. So if it showed 500, it's not going to help your credit score, but 300 or below, your credit score will just continue to rise, or if it's already at the top, it will just stay at the top. Third is length of credit history. Inquiries is the 4th one, so you don't want to have your credit pulled a lot. And then type of credit used. So auto loan, credit cards, the last 2 aren't as important though. So how do we determine what credit score do we use? It really depends because they're always different, but we are going to take the middle score. So if your Experian score was 750, TransUnion was 735, Equifax was 721, we're going to throw away the high, 750. We're going to throw away the low, 721. We are using 735 as your qualifying credit score. And with conventional, the minimum is 620. FHA, the minimum is 580. And then conventional FHA with the IDA down payment assistance program, you have to be at 640 for the credit score.
I just want to say that you just dropped a gem right there regarding the 30%. And this is something I'm going to do with my own personal credit, like the limit of my cards. I'm going to try not to exceed 30% of however much that limit is, because they keep on raising it for me, like saying my available credit is this much, and I'm, like I didn't even ask for that. I didn't even ask for you to give me an extra $2,000, but I'm going to keep that in mind. So
yeah, because that's the most important. Like I tell people, especially if you have really good payment history, I've had where someone has perfect payment history, but their cards are almost maxed out. Their potential score improvement, if they drop it, if they paid their credit cards to say like $20, sometimes it's like 100 points.
Wow.
So I've had a couple people where it was just like that. And we do a rapid rescore, they pay it down, they send me the documents, I do a rapid rescore, 3 days later, their score is 100 points higher.
Yeah. And even when it comes to certain debt, like student loans, a lot of people I know, including myself, I have a lot of student loan debt, and that's my biggest debt on my credit. So when it comes to you talking to individuals, is there a way or different programs that you introduce to help, bring down that, or like try to circumvent that some type of way?
Like the credit cards?
No, the student loans.
Oh, the student loans. The student loans are so tough right now because everything's been in forbearance. It's like, so how we have to look at student loans is when we pull credit now, all the student loans they show 0 for the monthly payment. So it's actually good right now. So for conventional, if you are in an income-based payment plan and your payment is truly 0, we use 0. If you're not in any plan right now, because a lot of people aren't, then we have to use 0.5% of the balance. And that's how we determine how much we have to put as the monthly payment. FHA is 0.5% also, but conventional is better because if you are in that income-based payment plan and it's zero, we're using zero, which helps a lot of people. So those are fairly newer that they start, because Fannie Mae is still 1%, but Freddie Mac, so there's two different types of conventional like lenders, I should say, that we sell them to. Fannie Mae, Freddie Mac. Fannie Mae still at the 1%, but Freddie Mac has been at 0.5%. They're same as FHA, but both of them will still do the income-based payment plan, and if it's zero, we'll use zero.
Okay.
So there's a bunch of people who have purchased who are in that income-based payment plan, and if they weren't, that monthly payment would have been like $500, but their income-based payment plan only shows that they're paying $50. So that helps them qualify for a lot more.
Okay. Thank you for that, Jim, as well.
Yeah. And I'm hoping they do a little bit more with the student loans. So that was credit. The second C is cash flow. So this is how we determine how much you qualify for. So it's called the debt to income ratio. So how we calculate that is we're going to take the housing payment for the home that you're purchasing. Then we're going to add the monthly debt that shows up on the credit report. So minimum credit card payments, auto loans, student loans, personal loans, anything that's on the credit report. And then we're going to divide that by your gross monthly income. So that's how we determine what your debt to income ratio is. So, and we'll get into an example of it. So for the housing payment, it's going to be the principal and interest, your homeowner's insurance, which you will shop for, real estate taxes, the mortgage insurance, flood insurance only if it's in a flood zone. And then if it's a condo or townhome, the HOA fees. So this would be an example of a monthly payment. So this is a $200,000 purchase price, 3.5% down. So this is an FHA based off of a 6% interest rate. So you got your principal and interest, real estate taxes, homeowner's insurance. So the total would come out to $1,765.35. And then for calculating your gross income, so if your salary, we just take your salary divided by 12, then hourly rate, we'll just take, if you work 40 hours a week, we're going to take, and your pay rate is 20, we're just going to take 40 times 20 times 52 weeks divided by 12. If you receive bonus and overtime, it does say 2-year average, but if you have been receiving it for at least 1 year and it's likely to continue, then we can use the bonus and overtime. Commissions is definitely a 2-year average. If you are self-employed, we are going to be taking the net income. So if you report on a Schedule C, you put your gross at the top of Schedule C, then you have your deductions, and then we have the net. We are going to, so for example, if I was pre-approving you right now, we're going to look at 2022 tax return, 2021 tax return, and we're going to average those two net years. And if, say, you had a really good 2021, say you made 100,000 net for 2021, but then you made 50,000 for 2022, we're just going to take 2022's income and divide it by 12. So here's an example. So this example, salary 50,000, housing payment 1,765.35 from the example from before. The debt from the credit report, we have an auto loan of 300. We got 2 credit cards, $30 each, And then we have a student loan that's $100 a month. So we have a total of $460. So now what we do is we take the housing payment plus the credit report debt. So that equals 2,225, sorry, 2,225 divided by their gross monthly income of 4,166. That comes out to a 53.41% debt to income ratio. Now look at these max debt to income ratios. Conventional, we can go up to 50%. FHA, we can go up to 55%. Conventional FHA with the IDA down payment assistance program, we can't go above 45%. So for this example, we would only be able to go with FHA at the $200,000 purchase price. If you wanted to go with the conventional FHA IDA, we would have to lower the purchase price. So we'll talk about the last C right after this IDA. So I want to get into the IDA down payment assistance before we talk about the last C of what you need to bring to closing. So it's available to first-time and non-first-time home buyers. Must purchase a 1 to 2 unit single-family property within the state of Illinois. Borrowers must occupy property as primary residence. No non-occupant co-borrowers allowed for IDA. So that would just mean, say there was a family member, say your debt to income ratio was 60%. And you had a family member that said that they would go on the loan with you, but they weren't living in the property. They're going on the loan because they got income, more income than debt to help out with that debt to income ratio, but they're not going to be living in the property. So they're just co-signing. So IDA does not allow a non-occupant co-borrower. It's a 30-year fixed rate, VA, FHA, USDA conventional. There is an income limit. The minimum credit score, like we talked about, 640. Max debt to income ratio 45%. Borrower must contribute 1% of purchase price or $1,000 from buyer's own fund, whichever is greater, and we'll talk about more about that in a little bit. And then home ownership counseling is required. You just take it online. They give you a certificate and you send it to us. There's only one interest rate offered each day. So I get an email every day of what the interest rates are, which I'll show you an example. Let's see, IDA down payment. So IDA is a second lien. It's a second lien. So the interest rate that they offer, it's not for what they're giving you. It's going to be for the first mortgage. So the second lien is 0. And then what they're giving you as the interest rate, which I think is the next one. So here's an example. So here are today's rates. So this first one, this HFA1, this is their new program. This is the 10,000 deferred. Today, the conventional interest rate is 6.5 and FHA's is 6.125. And then you can see the forgivable 6,000, 6.625 conventional, 6.25. Deferred is the same as the 10,000, and then the repayable is 6.375 conventional, 6% for FHA. So here are the income limits. So for Cook, Kane, Lake, McHenry, McLean, Will, the max income limit is $125,040. Now it says household income. If a husband and wife they make 175 together, but if one of them qualify by themselves and they're the only ones on the mortgage, we're only going to count that income. So if that other person makes 75,000 and they qualify, then we can just put that person on the application, and then the spouse can still be on title. So we can make it work so that if they are over, then we can maybe take one of them off so they're then under the income limit. And then the max purchase price is $349,525 for a single family, and then a 2-unit. If you're looking at 2 units, $447,542. So now let's talk about the last C. So for a purchase, there's 3 buckets of cash. The first bucket is your down payment. So that will either be 3% for conventional or 3.5% for FHA. The second bucket is your closing costs. Typically, closing costs are around $5,600. That includes everything. That's your attorney fee, all the title fees, appraisal. That's including everything. Now, IDA does have an origination fee of 1%, so it's 1% of the loan amount. So if you weren't going IDA, it would typically be $5,600, but with IDA, it's a little bit higher. And then the third bucket is called prepaid items. This is setting up your escrow account for your real estate taxes and homeowners insurance. So if you don't put 20% down, you're required to escrow. So escrowing is just think of it as a savings account for your real estate taxes and homeowners insurance. So when you make the monthly mortgage payment, the monthly real estate taxes and homeowners insurance are going to be included also in there. So we have to set it up so that you have enough in there at the time of closing. Illinois, the real estate taxes are in the rear. So the taxes that are coming out this year are really for last year, 2022. You didn't live in the property. So the seller is going to give you a real estate tax credit, and that almost always covers the third bucket. The only time it does not is if it's new construction or if there's a senior exemption or senior freeze on the tax bill. So let's take a look at, so this one is FHA 10,000. We can say it's the deferred, the new one, the deferred 10,000 one. So, and going back to the 1%, so they want you to put 1% of your own funds into the transaction. So when you go to contract, there you have to give an earnest money check that the seller holds on to, but that goes towards your down payment. So typically we tell people to just put the 1% as your earnest money. So if you can see in this chart, we have a purchase price of 200,000. We're going to put 2,000 for the earnest money. Then IDA is going to pay for the rest of the down payment of 5,000. So first bucket is 0. Your 2,000, IDA's 5,000. So the closing cost, we got a total of 7,530. So we have IDA, we have 5,000 left from IDA, so 5,000 is going to be taken care of. And then we have 2,530 left over. One of the things that you can do is you can negotiate with the seller to
Okay, I think you're frozen, Tony.
closing 530 costs. The seller's taking care of the rest of it, and then you're left with closing costs.
Okay. Hold on. Labrita, can you hear me? Can you hear us?
Yes, I can.
Okay. Can you hear Tony?
Can you hear me?
Yes, I can.
Okay,
Yes.
perfect. Perfect. And if you got any questions during this time, please by all means stop us and ask.
Yeah.
What he's currently talking about is the breakdown, and definitely take some notes during this. And what he's saying about the 1% loan amount, using it as the earnest money, that's what we generally do anyhow. I usually tell my clients when it comes to earnest money, put down 1% anyhow, if they can't at least have
Sometimes
of
more
whatever the house
nowadays.
is most worth. So yeah.
Yeah, because that earnest money is protected. So if something does go bad with the financing, you will get that earnest money back. Or if the appraisal comes back in lower and the sellers won't drop the price, you'll get that earnest money back. So that is the break. Oh. So this is just another example. This is the 10,000 repayable. So we got the $83.33 added here. So, and this is assuming a 6% interest rate. So your total monthly would be $1,848.68 for that program. So here's just another example. This is the 7,500 based off of a 150 purchase price. So this one you'd put 1,500 for earnest money, 1% of the purchase price. IDA is going to cover the rest of the down payment, 3,750, and then IDA will then have 3,750 left over from IDA, so that will go towards the closing cost. And in this example, you would want to try to get a closing cost credit from the seller of 3,297.50 cents, and you would just be putting into it 1,500. And then I think the last example, and this is example of 150. So and there's obviously 0 for the down payment assistance because this is the 7,500. So this one, it would come out to 1,424.02 cents. I think I just have one more. So this would be an example if the debt, say your debt to income ratio is too high. It's not at 45%, it's at 50%. We can't go IDA. So this is what it would look like if you didn't get IDA. So you put 2,000, this is based off of 200,000, 2,000 for the earnest money. Then your additional down payment, which would be at closing, would be 5,000. Then your closing costs, you got 5,600. And so the total without IDA would be 12,600. Now, you still could negotiate a seller closing cost credit. So for conventional, you can receive 3% of the purchase price. And then for FHA, you can receive up to 6% of the purchase price, but it cannot exceed bucket number 2 and bucket number 3, which bucket number 3 is always going to vary. But even if you got 5,600, then all you have to bring is your down payment to closing. So a lot of people do it that way if they don't qualify for IDA. So 3 buckets of cash. So bucket number 1, down payment, we talked about this. 3% for conventional, 5% for conventional if you're not a first-time home buyer. 3.5% for FHA. Closing costs, approximately 5,600, additional 1% fee if using IDA funds. And then who pays? You can pay, IDA can pay, and then Vanessa can negotiate to have the seller pay also. Oh, and then the last thing, if we don't go with IDA, another way to get a closing cost credit is we can give a closing cost credit. So what we can do is, let's say the interest rate today is 6.5%. What we can do is we can increase the interest rate, and then we can give you a closing cost credit. So maybe we bump it up to 7%, and then the closing cost credit would be 5,600. Then we're covering the closing cost then, but it is a higher interest rate. So in order to get the seller to give a closing cost credit, you must first set the table of expectations. So I'll just get to the example. So say the list price is, or say the list price is 210, and you submit an offer for 200,000. And you are also asking for a $5,000 closing cost credit. The seller comes back and says, we'll do the 200,000, but we will not give the 5,000 closing cost credit. Then if you really need the closing cost credit, you go back to them and say, okay, we'll bump up the purchase price to 205. You give us the 5,000. They're still getting their 200,000 that they said that they would agree to. So they'll never say no to that. And then Vanessa will check to make sure that the home will appraise for the increased purchase price. And then this is bucket number 3. We talked about this. This is the escrow account. The one thing I didn't talk about is prepaid interest. So prepaid interest, it depends on what day in the month that you close. Typically, people will close the end of the month. So say you did close the middle of the month. Say you closed the 15th. You would have 15 days left in the month, and they will charge you 15 days of interest, which the bucket number 3, this is all included. That real estate tax credit will still cover all of this. But that's typically, and the reason why they charge you for the rest of the month is, say you closed in June, your first mortgage payment will not be till August 1st. So you skip a month. So, and that August 1st payment is really for all of July. So you're not really skipping, it's just in arrear. It's 1 month back every time you make the payment the 1st. And then we always put 3 months of homeowner's insurance into your escrow account at the time of closing. And then depending on what month we close, for the real estate taxes, it'll either be 2 to 8 months. So I did that. So how much down payment do I need? As little as 1% if we go IDA. How much savings do I need in the bank? Could be 0. Besides the 1%. How good does my credit score need to be? 580 to 640 or better. What does my housing payment consist of? Principal and interest, homeowner's insurance, real estate taxes, mortgage insurance, and then if a condo or a townhouse, HOA fees, HOA dues. What are closing costs? They're going to be about $5,600. And if we go IDA plus the 1%, and then the escrows we talked about, and then how much loan do I qualify for? That is the debt to income ratio, not to exceed 45% for conventional, FHA IDA, conventional 50%, and then 55% for FHA. So now, and that is about all. Well, so if you are looking to get pre-approved, these are all the documents that we'll be asking for eventually. For pre-approval, all I care about to start are your income documents. So most recent 30 days worth of pay stubs, last 2 years of W-2s, and then most recent tax return. And then if you're self-employed, I will need the last 2 years of personal tax return. And if you have business tax return, 2 years of that also. And then this is my contact information. And then we do have an app that has mortgage calculators, and you can also fill out an application to get pre-approved. You take the QR code. If you take your phone and scan the QR code, you can download the app. And then I think.
So if you have
Any
your
questions?
phone, just go ahead and scan that QR code and move forward with it. But yes, do you have any questions for us?
Yeah. No, it's a lot.
It was. It was class. Class was in session.
Yeah.
And everything doesn't have to be done all at once. If you're just getting started with this particular journey, we will work with you up until you get your actual pre-approval and you move forward with the process. And everything is an open door policy. You can access anything during that particular time as well.
Yeah. I mean, the first thing people ask me is credit score. Credit score is number 1. And then debt to income ratio is number 2. Once we have those 2, we'll figure out the what you're bringing to closing.
Mm-hmm.
But the first 2 are the most important.
Yes, the first 2 is the most important, and then we need some money to purchases.
Yeah.
Cash flow, how much money you make in general
Yeah,
it's
and obviously we can maneuver what you're actually bringing with seller credits, IDA, lender credit, all sorts of stuff we can get creative with.
Absolutely. And with that being said, it's all about your particular preference. Any style home, it's 1 to 2 units. So
Yeah, for IDA. And we can do 4 units. We can go up to 4 unit. We just won't be able to go IDA.
right.
But that will still be 3.5. If it's going to be your primary, it will still be 3.5% down for a 4 unit,
Absolutely.
which a lot of people do that. You got 3 rental units. And then
Wow.
down the line, people will then convert it into a full investment, and then they will buy their primary single family home.
And that's how you build income. That's how you create generational wealth.
Yep. I wish I did it that way.
Yeah. Well, if there isn't anything else that we can help you with today, we can end up closing the seminar, but I do appreciate you for coming on, and thank you so much for giving us the time of day.